Hello, today I'm going to talk about adjusting a calendar trade that's gone against you. What we're going to be looking at is we're going to be looking at GDX, and GDX has about almost a month ago it was trading pretty flat. The volatility was, the IV ranking was really low, and what you're looking for on calendar trades is a low volatility ranking so that you can take advantage of volatility expansion on your far term long option, so that it will increase in value more just because of volatility going up. So you can see that, okay, it was around here. I thought, well, maybe it's put in a bottom, it's going to go up. So I drew this these two bars right here, thinking that this is going to be probably the range somewhere around here, and I was hoping to target about $25 by this June expiration period as an ideal target on there. So I opened up this as a call calendar at $25. I'll go back there in a second to talk about how much I paid for that. But as you can see, it immediately went against me and went down, broke through that range. I didn't really have much time to adjust it at that point. So what I decided, especially since it gapped down right here and all in one day, and then it's been sitting here since then. And so what I'd like to do now is I went ahead and let the near-term short position pretty much expire. I actually closed it out, but it was just about a few cents left on it. I just closed it out just to be able to manipulate this position without worrying about having an unmatched short position in a non-marginable account. Anyway, so here we are today. It's GDX, the gold miners. You got to make an assumption on calendars all the time. Do you think it's going to keep on going down? Do you think it's going to go up? To be honest, it could do both. Who knows? You never know. I'm hoping at this point that we're going to get an up market, and I got calls put in place, so that's part of the reason that I'm hoping it's going to do it. Not that I have any insight in GDX, nor probably does anybody else in the entire world. So let's see if we can make money on this still, even though that it went against me. So let's go back to the Analyze tab, and we'll show you. Here's what I have left. I just have that far term position that was put on for a September of 2014. It's a 25 call. I paid $1.16 for it. I bought 10 contracts, so that's $1,160 is what that cost. I don't show what my original basis was for the June 25 call, but at the time I believe it was almost 50 cents. So my net position on this thing right here was probably maybe 65 cents of debit, because I got credit for this. The difference between these two prices is actually what I paid for the trade. So let's say I have $650 into this trade once I collected the premium for this short, which I did already. So if we'll notice this trade, if I don't do anything, I just sit on this call and let it go to expiration. The price doesn't change. If you look right here, this red number here will tell you the price, where this is red, and this is the $25 expiration. Anything less than that $25 September expiration, I'll take the full loss on it, which is the $1,160. Again, this $1,100 is not what my actual loss is, since I did take credit for that. But let's ignore this for now, and we'll talk about what can we do now to this trade, because normally what I would do on a calendar is I've taken my credit for the June, now I want to take credit for July. But when I look at the July options at $25, the July options, let's go up to it, at $25, they're not paying anything. 14 cents right there, 13 to 15. So 14 cents, and that's just not enough premium. I want to collect more for that. And the reason I can't collect any more than that is because now we're just so far out of the money that there's not a lot of extrinsic. Here's my extrinsic value, 14 cents. there's not a lot of extrinsic value. You can see the extrinsic value is at the highest right there near the at the money price, 22.29, and this is the 22.5 strike. So we got a 73 cents of extrinsic value at that point. So again, we could try to sell it down here, but then what we're doing is we're actually selling a short trade because we're selling it for less than what our basis is. So when you think of a covered call for a stock, for example, if you have a stock that's at $75 and you want to sell a covered call, typically you're going to sell that covered call for $75 or more. You can sell it for less, but that's the price that you're going to be forced to sell that position when it expires, unless you close it out prior to expiration. So yeah, we could do that and then hope that and get as much money as we could from that. And the other part that may be an advantage or argument towards doing that would be that this September 25 call probably won't depreciate that fast either from there, because it's so far out of the money now. It's not going to change a whole lot. But I want to try to move this covered call closer to in the money so that I can collect a greater premium on it, and eventually maybe I can get my premium that I'm selling on the front months to cover the cost of my long call option and basically get a free call position. So what I've elected to do on this is to sell a back ratio spread, and a back ratio spread is just unbalanced combination of what you're buying to what you're selling at either two different dates or two different. Just usually done at the same expiration period, but they're done at different prices, and then you're varying the quantities of what you're buying and selling. This particular back ratio spread is a 2-to-1. I'm selling twice as many as I'm buying, and I'm selling the 25, which is what my current position is. So I'm selling my 10 contracts of my 25 September position, and I'm buying 5 contracts of the 23 strike price on the same month. And the nice thing about that is, I've already taken my loss because of the depreciation for this. So really, all I'm doing is I'm just repositioning to help me make more money in the coming months on here. And so, and not putting more money into this trade to have a potential of losing more. So I'm able to do this for just 6 cents. So with the 5 contracts on there, it's 6 cents per. You're talking about $30 you're adding to your cost basis of this trade. So let's take a look again at what that's going to look like on the risk profile. So here's my call option, and the red line represents the September expiration date, and the white line represents the value of it based on any of these prices that this option would be today. So if this option was 26 today, I could get the $1,099 for that position right now today if it went up to that price. But today we're down here where the white line is. You can see the numbers on the left and the date that it shows. So for today, that position is really worth $673 from where I paid for it. Okay, and that's based on this $1.16. It doesn't have anything to do with the credit I received on the June contracts that I sold. Okay, so let's go ahead and apply this particular trade, and what it will do is it will balance out this position. So it will account for this cost that I paid. It will zero out the shares at September for the 25 strike, and it will add 5 new shares at the 23 strike. So when I do that, we notice that this white line hasn't changed really at all. It's right now it's at 691, and we said before that it was at 670. So There's a few dollars difference, but again, we're having to pay that 6 cents to get into this position. That hasn't changed. The other thing that you'll notice too is that this bottom line, my max loss of my long position when I get there, hasn't really changed either. It's actually, it's $30 more, but basically it's the same thing. But the big difference on it is where it starts going up in value. It starts going up in value now at $23, where before I did that trade, it starts going up in value at the $25. So I can start making money sooner, or the stock doesn't have to go up as far for me to start making more money on it. So that's what I want to take advantage of. I need to lower that strike. So I've moved that. Basically, I've moved that elbow down to here, and that's what I was looking for. And it also makes that, or this position, this long position for the September with this back ratio spread on it, I can get break even, at the price by July 18th gets up to 24.63. So that's not too bad. I like that. It's a whole lot better than where I was before this trade. 24. It looks like I'm about break even at the same spot. So it really doesn't change that part of it, but it sets me up where I can do some more things. Let's show you what that looks like. So now that I have a 23 price basis for my long position, my long calls, I'll look at what I can do to sell some calls, like the covered call, to be able to lower my cost basis. So now that I'm not at 25 anymore, I'm down at 23, I can start selling these options and still not take on a debit trade. So let's say at the $23 strike, I can sell it for 51 cents here, or actually it's 53 cents, and I would probably try to get 53 cents out if I did that, when I sell that. But let's add that to our position, and what that's going to do, it's going to take 5 shares, 52 cents, so just over $250, and that basically brings everything up on that graph, $252, but it also caps my gains. So once that $250 is realized in terms of the price going above 23, that's the break-even point for this particular position if it was held just to expiration of July. Or 50 cents above the 23. So let's take a look at that again. So we got 23, we go up to 50 cents. So that's about where this price right here is approximately where not selling this option becomes an advantage. Everything to the left now at this point, it's to my advantage to have sold that. So I've really protected myself a little more on the downside, unless it moves all the way up to 23.5, which it could do. We're at 23.5. There's a 26, almost a 27% chance that could happen, and so, but the higher probability is that it's going to stay less than that, and I've lowered my cost basis for this whole trade. So I like it in general. And not only that, if it goes up to here, anywhere around here, I'm not worried about it, because what I'm going to do is I'll go ahead and take that $23 call option that I'm selling right here, and I'll sell another option in August and collect the intrinsic value for that to, again, give me a potential profit for my trade. So anyway, that's it. I hope that makes sense to you. And one other thing too I want to show you is that if we go back in here and we day step this, we can see how these lines right here represent different times. Each one of them is 11 days apart, where the white line is today. You see the white line here. And red line, orange line, they go in increasing date order by 11 days. So you can see in 11 days it goes up to this red line. 22 days it's orange line, yellow line, 33 days, and then in the 44 days you get up to this green line, which is right close to expiration. And you can see that's, if we're from here to here, if it's in that range, holding this trade all the way to expiration is to your advantage. Anyway, hope you learned something, and we'll talk to you later. Bye-bye.